The number on the collateral assessment was $412,000. Norman Breck had been looking at it for 10 minutes, sitting across from the loan officer at First Plains Agricultural Credit in Garden City, Kansas, and the number had not changed in those 10 minutes and was not going to change regardless of how long he looked at it. He was 71 years old. He had been farming 3,800 acres of dryland wheat, grain sorghum, and limited irrigated corn in Finney County for 43 years. He had borrowed money from this bank for 31 of those 43 years and had repaid every dollar on or before the agreed terms, which was a record he was aware of and which he had assumed the bank was also aware of. The collateral assessment did not suggest the bank shared his awareness. The assessment covered his full equipment fleet: 6 Massey Ferguson tractors, a combine, 2 grain carts, a sprayer, and the tillage and planting equipment associated with a 3,800-acre operation. The bank's internal valuation model had produced $412,000 as the aggregate current market value of those assets. Norman's own estimate of their market value, based on his direct observation of what comparable equipment had been bringing at regional sale barns over the previous 18 months, was substantially higher. He had not arrived at his estimate through wishful thinking. He had arrived at it through the same method he used to arrive at every number that mattered to his operation: by watching what things actually sold for and writing the results in a notebook. The loan officer's name was Brad Fillmore. He had been in agricultural lending for 11 years, the last 4 at First Plains. He was 38 years old and was competent at the documentation and analysis aspects of agricultural lending in the ways that the current regulatory environment required competence. He was less familiar with the actual market behavior of used agricultural equipment, which was a gap in his knowledge that had not previously caused a significant problem because the bank's internal valuation model, produced by a regional agricultural appraisal service that updated its values annually, had generally tracked the market closely enough that the gap had not been consequential. The previous 3 years had been unusual. Used agricultural equipment prices in the Central Plains had moved sharply upward across 2021, 2022, and into 2023, driven by a combination of factors that had not appeared together in the market within recent memory. New equipment supply had been constrained by manufacturing disruptions and component shortages that left dealers with thin inventories and extended lead times, pushing buyers who would otherwise have purchased new into the used equipment market. Parts shortages and escalating repair costs had simultaneously made fleet operators more reluctant to trade in aging but functional machines, reducing the supply of quality used equipment coming to auction. And a commodity price environment that had delivered strong returns to grain operations across the Central Plains had given medium and large farming operations both the motivation and the capital to compete aggressively for good used equipment when it appeared. The result was a used equipment market that had behaved unlike anything that had preceded it in the previous decade. Prices at regional auctions running 20 to 40% above the levels that models built on pre-2021 data would have projected, with the gap widening as new equipment supply remained compressed. The regional appraisal service that produced the bank's internal model had updated its values annually, as it always had, but the annual update cycle had lagged the market's actual movement by enough that the current model reflected something between last year's market and the year before's, rather than the market as it existed on the day Norman Breck was sitting across from Brad Fillmore with a collateral assessment showing $412,000 on 6 Massey Ferguson tractors that Norman believed were worth considerably more. The model was not wrong in its methodology, it was wrong in its timing. In a stable market, an 8-month lag between update cycles and current conditions was inconsequential. In the market that had existed across the previous 3 years, 8 months was the difference between an accurate valuation and a significant understatement. He asked Brad where the $412,000 figure had come from. Brad explained the internal valuation model, the annual update cycle, the regional appraisal service, the methodology that applied depreciation schedules and condition adjustments to published market data. He said the model was the standard the bank used for all agricultural equipment collateral, and that it had been validated by the bank's external auditors as a sound methodology. He said he understood that Norman might have a different view of his equipment's value, and that it was natural for borrowers to believe their assets were worth more than a lender's conservative model produced. Norman said he understood the methodology, and that he also understood the difference between a borrower who believed his assets were worth more for the psychological reasons that borrowers sometimes had, and a borrower who had been attending regional equipment auctions for 3 years, writing sale prices in a notebook. He said he was the second kind of borrower, and that his estimate of his fleet's current market value was based on documented transaction data rather than on what he hoped his equipment was worth. He said his question was whether the model's current outputs reflected the market as it currently existed, or as it had existed at the time of the model's most recent annual update. Brad said the model was updated annually, and that the last update had been 8 months ago. Norman said he understood. He said 8 months was a meaningful interval in a market that had been moving as quickly as the used equipment market had been moving, and that he had reason to believe the model was understating current values by a significant margin. He said he was willing to demonstrate that reason if Brad was willing to see it. Brad said he appreciated Norman's perspective, and that the bank's position was that the model produced a conservative and defensible valuation that protected both the bank's interest and the borrowers. Norman said he understood the bank needed conservative valuations for lending purposes. He said his concern was not that the valuation was conservative. His concern was that it was inaccurate, and that inaccurate in the downward direction had consequences for the restructuring terms that would affect his operation's viability in a way that he did not believe the inaccuracy warranted. He asked whether the bank had a process for an independent appraisal when a borrower disputed an internal collateral assessment. Brad said the bank's policy allowed for an independent appraisal at the borrower's request and expense, with the understanding that the bank would consider the independent appraisal as part of its collateral determination, but was not obligated to accept it in place of the internal model. Norman said he understood. He asked for the policy in writing. Brad provided it. Norman read it, folded it, put it in his shirt pocket, and said he would be back within 2 weeks. He drove home on the same county road he had driven for 43 years, at the same speed he had always driven it, and did not make any phone calls until he was back at his farm and sitting at his kitchen table with his equipment notebook open in front of him. The notebook was one of 17 that occupied the shelf above his shop workbench. He had been keeping them since 1987, when a machinery dealer at a farm meeting had told a room of farmers that a man who didn't know his per-hour operating cost on each machine in his fleet was flying blind, and Norman had decided that flying blind was not something he was willing to do. Each notebook covered approximately 2 years of operating records across his full fleet: fuel consumption, repair costs, service intervals, parts, labor, field hours, seasonal hours, and a page at the front of each machine's section that showed the purchase price, the purchase date, and his running estimate of current market value based on the auction results he had been tracking since he bought the machine. He opened the current notebook to the fleet summary page he maintained at the front. 6 tractors, 3 MF8S.265 units, 2 MF7S90 machines, and 1 MF6S.155 that he used primarily for loader work and field maintenance. The notebook showed his market value estimates for each, updated 4 months earlier after he had attended the High Plains equipment auction in Dodge City and watched 6 comparable machines sell across 2 days. He had written the sale prices in the notebook at the auction. He had adjusted his fleet estimates accordingly. His aggregate estimate for the 6 tractors was $591,000, not $412,000. The difference was $179,000 on the tractors alone. He had not yet compared the bank's valuations on the combine, the grain carts, the sprayer, or the tillage equipment. He pulled the bank's itemized assessment from his shirt pocket and worked through it machine by machine against his notebook estimates. By the time he finished, The aggregate gap was $338,000, which he rounded to $340,000 in his notes, because he preferred round numbers when the precision of the underlying estimates did not justify more specificity. He called an agricultural equipment appraiser the following morning. The appraiser's name was Kenneth Strand. He operated out of Wichita and had been appraising agricultural equipment in Kansas, Oklahoma, and southeastern Colorado for 26 years. He was certified by the American Society of Agricultural and Biological Engineers and had provided appraisals for estate settlements, insurance disputes, bankruptcy proceedings, and lending collateral determinations across his entire career. Norman had used him once before, 12 years earlier, for an estate-related valuation on equipment he had inherited from his father-in-law, and had found his work thorough and his numbers defensible, in the way that numbers produced by a man who watched the market daily for 26 years tend to be defensible. Kenneth said he could be on site within 10 days. His fee for a full fleet appraisal of Norman's size was $3,400. Norman said he would have a check ready. Kenneth said he would need access to all maintenance records, service histories, and any available documentation on repair work and parts replacement across the fleet. Norman said he had 17 notebooks. Kenneth arrived on a Tuesday morning. He spent 3 hours going through the equipment, walking each machine, examining operating hours, assessing external condition, and reviewing service access points systematically against a standardized checklist that he photographed along with the machines. He operated each machine briefly, where the hours and condition warranted it, listening for the specific sounds that an experienced appraiser listens for, and that a bank model built from published data cannot hear. He asked Norman questions about specific machines as he went, not about their value, but about their history, their usage patterns, what work they had done, and in what conditions. He spent another 2 hours with Norman's notebooks, which he went through with the attention of a man who understood immediately what he was looking at. He had been in operations where the service records were a folder of receipts in no particular order, and operations where there were no records at all. And he had learned across 26 years that the quality of a fleet's documentation was a direct indicator of the quality of its maintenance, because farmers who tracked their maintenance tracked it because they did it, and farmers who couldn't produce records often couldn't produce them for the same reason. Norman's 17 notebooks were, in Kenneth's experience, among the most complete operating records he had encountered in a single fleet evaluation. He said so, briefly, and Norman said he had been keeping them since 1987, because a man at a farm meeting had told him he was flying blind without per-hour operating costs, and he had decided flying blind was not acceptable. Kenneth said the man at the farm meeting had been right. He asked Norman 3 questions about specific repair events and their outcomes. Norman answered all 3 from memory and offered the relevant notebook pages as confirmation. Kenneth photographed the pages. Kenneth said he would have the written appraisal within 5 business days. It arrived on the 4th day. Norman read it at his kitchen table. The aggregate appraised value of his full equipment fleet, as determined by Kenneth Strand's independent assessment using current market comparables drawn from regional auction results, dealer retail listings, and the appraiser's own documented transaction database, was $754,000. The bank's internal model had produced $412,000. The difference was $342,000. Norman wrote $340,000 in his notebook because that was the number he had estimated before the appraisal, and he was not going to adjust his documentation to match the appraisal's more precise figure. The appraisal confirmed the order of magnitude. The specific number was close enough to his estimate that the confirmation was complete. He called Brad Fillmore and said he had the independent appraisal and would like to schedule a meeting. Brad said he could meet Thursday morning. Norman said Thursday was fine. He drove to Garden City on Thursday with the appraisal in a manila folder and his current equipment notebook under his arm. He set the folder on the desk in front of Brad and said he would like Brad to read it before they discussed the restructuring terms. Brad read it. He read it with the careful expression of a man who is reading something that creates a problem he was not expecting and who is working out, while reading, what the professional response to the problem should be. When Brad finished, he set the appraisal on the desk and said the number was significantly different from the bank's internal model. Norman said he was aware of that. He said the difference was $342,000, or approximately 83% above the bank's figure on the same fleet, and that in his experience, an 83% gap between a model and an independent appraisal by a certified professional with 26 years of market data behind him suggested the model had a problem rather than the fleet. Brad said he would need to discuss the appraisal with his supervisor and with the bank's risk department before he could make any determination about how it would be incorporated into the collateral assessment. Norman said he understood that. He said he wanted the bank to understand that the restructuring terms he was being offered under the $412,000 collateral figure were terms that his operation could not sustain, and that terms calculated against the appraised value of $754,000 were terms he could sustain and intended to honor in the same way he had honored every previous obligation to the bank. He said he was not asking for anything he was not entitled to under the bank's own policy, which he placed on the desk beside the appraisal, the written policy statement Brad had provided at the previous meeting, which Norman had read carefully, and which stated specifically that the bank would consider an independent appraisal as part of its collateral determination. Brad said he appreciated Norman's thoroughness. Norman said thoroughness was not a character trait. It was an operational necessity for a man who had farmed 3,800 acres for 43 years, and who had learned that the people who made decisions about his operation's financial structure were not always working from accurate information, and that the only person who could be relied upon to correct that inaccuracy was the man whose operation was affected by it. The supervisor meeting happened the following week. Norman was not in the room. He received a call from Brad 4 days after the supervisor meeting. Brad said the bank had reviewed the independent appraisal and had determined that the current internal model's values for the specific equipment categories in Norman's fleet were understated relative to current market conditions, and that the bank would be adjusting the collateral assessment to reflect the independent appraisal in calculating the restructuring terms. He said the adjusted collateral assessment would change the loan-to-value ratio in a way that materially improved the available restructuring options. Norman asked what the new collateral figure would be. Brad said $698,000, not the full appraised value, because the bank applied a standard haircut to appraised values for collateral purposes, but substantially above the original model figure. Norman said he understood the haircut and that $698,000 was a number he could work with. He asked how quickly the restructuring proposal could be revised. Brad said he could have revised terms by the end of the following week. The revised terms were on Norman's kitchen table on a Friday afternoon. He read them twice. He called his farm accountant, a woman named Joyce Hartley, who had managed his operation's financial records for 18 years and who understood his cash flow structure with the depth that comes from 2 decades of working with the same operation through good years and bad ones. Joyce read the terms and said they were workable. She said the original terms would not have been workable, and that she had been concerned when Norman described them after the first meeting. Norman said he had been concerned too. Joyce asked how he had known the bank's valuation was wrong. Norman said he had not known with certainty. He had known that his notebook said one thing and the bank's paper said another, and that in his experience when his notebook disagreed with someone else's paper, it was worth finding out which one was right. Joyce said that was a very Norman Breck answer. Norman said it was the answer he had. The restructuring was finalized in the 3rd week of October. Norman signed the documents at the bank and drove home in time to check on the wheat planting that his hired man had been running in his absence. The ground was going in well. The MF8S265 on the planting pass was running cleanly as it had run since he bought it, accumulating the hours that Norman recorded in his notebook and that Kenneth Strand's appraisal had converted into a current market value that the bank's internal model had failed to identify. The equipment had not changed between the bank's assessment and Kenneth Strand's appraisal. The machines had sat in the same shed, they had the same hours, the same maintenance records, the same condition. What had changed was the quality of the information being applied to them. And the quality of the information had changed because Norman Breck had requested an independent appraisal and paid $30,400 for it, and sat across from a bank loan officer and placed it on the desk beside the bank's own policy statement. The investment had returned $342,000 in adjusted collateral. Norman wrote that figure in his notebook under the date of the bank's revised assessment, not as a point of pride, but as a data point, the specific demonstration that the market value of his Massey Ferguson fleet, as determined by a certified appraiser working from 26 years of documented market data, was not the number the bank had produced, and was not a number he had been willing to accept without verification. He had farmed for 43 years by not accepting numbers he had not verified. He was not going to stop that practice because the number was on a bank's letterhead. The equipment was in the shed, the wheat was going in, the notebooks were on the shelf, the restructuring was signed. Norman Breck drove back to his farm and walked out to the equipment shed and stood for a moment looking at the row of Massey Ferguson machines that the bank had said were worth $412,000. Kenneth Strand had said they were worth more. The market, which did not care about internal valuation models or annual update cycles or loan-to-value ratios, would eventually say what they were actually worth in the plainest possible terms, at an auction, in front of bidders who had driven from across the region because they knew what the equipment was worth and were willing to pay for it. Norman knew what that number would look like. He had been watching it build at sale barns across western Kansas for 3 years, writing it in his notebook every time a comparable machine came across the block. He had been right about the number before the appraisal confirmed it. He would be right about it when the auction came. The bank's loan officer would not be there to see it, but the notebook would be.